Welcome to this comprehensive masterclass on profit planning, budgeting, and budgetary control for managers. In today's competitive business environment, financial planning isn't just a back-office function, it's the strategic backbone of successful organizations. Whether you're an MBA student preparing for your career, or a manager looking to enhance your financial acumen, this course will transform how you approach corporate finance. We'll explore real-world applications, practical tools, and strategic frameworks that will make you a more effective financial leader. Let's begin with Chapter 10.1, Financial Planning. Financial planning refers to the process of estimating the capital required and determining its structure and sources. It is the comprehensive blueprint for a firm's growth, profitability, and financial health. Financial planning ensures optimal allocation of available resources by anticipating future needs and strategically aligning investment and operational decisions. Managers can lead their organizations towards stability and growth. It's crucial to understand the distinction between personal financial planning and corporate financial planning. Personal financial planning involves managing an individual's income, expenses, savings, and investments to meet personal goals like retirement or education. Corporate financial planning is the strategic planning of a business's financial activities to ensure sustainability and growth, dealing with larger scales and complex regulations. A manager plays a pivotal role in aligning organizational resources with financial objectives. Effective financial planning by a manager involves several key areas: resource allocation, directing funds to high-return projects, and minimizing wastage; capital budgeting, choosing investments that align with the strategic vision; cash flow management, ensuring liquidity and timely payments; cost analysis and control, identifying cost centers and optimizing them for profitability. Moving to Section 10.2, the objectives of financial planning. Financial planning serves 6 critical objectives that every manager must understand. First, ensure adequate funds. Financial planning guarantees that sufficient funds are available at the right time to meet business obligations and capitalize on opportunities. Second, cost reduction. By minimizing financial mismanagement and duplication of resources, financial planning reduces operational costs significantly. Third, growth and expansion. It enables planned investments in new markets, capacity expansion, and innovation initiatives. Now let's explore Section 10.3, the 5 steps of financial planning. These steps provide a systematic approach to effective financial management. Step 1. Assessment of current financial position. This involves thoroughly analyzing the organization's present financial state, including assets, liabilities, and income streams. Step 2. Determination of financial goals. Setting both short-term and long-term financial goals using the SMART framework: specific, measurable, achievable, relevant, time-bound. Step 3. Estimating capital requirements. Calculating how much money the business needs, including both fixed capital for assets and working capital for daily operations. Step 4. Formulation of financial policies. These policies guide how funds are raised, allocated, and managed, including credit policies and debt-equity ratios. Step 5. Monitoring and reviewing the financial plan. This involves regularly monitoring implementation, comparing actuals with forecasts, and making necessary revisions. Managers must create dashboards and periodic review mechanisms using variance analysis and scenario planning to adjust for any deviations proactively. Section 10.4 explores the importance of financial planning. While personal financial planning focuses on individual wealth management and risk protection, corporate financial planning deals with managing organizational finances to ensure business continuity, scalability, and profitability. Key purposes include maintaining business continuity, optimizing capital allocation, and winning investor and stakeholder trust through transparent planning. It harmonizes goals across departments, forecasts cash flows and profits, and enables adaptability to market and economic changes. Section 10.5 outlines the characteristics of a sound financial plan. These 7 characteristics ensure your financial plan is robust and effective. First, simplicity. A financial plan should avoid technical jargon, using clear language that everyone from junior executives to board members can understand. Second, flexibility. The ability to accommodate changes in internal goals or external environments through contingency clauses and rolling forecasts. Third, liquidity. Ensuring sufficient availability of cash or near-cash assets for meeting obligations like salaries, loan repayments, and emergencies. Fourth, risk minimization. Incorporating provisions to manage financial, operational, and market risks through insurance, reserves, and uncertainty buffers. Fifth, profitability focus. The plan must guide the enterprise toward higher returns through efficient cost control, pricing strategies, and product mix optimization. Sixth, optimal capital structure. A healthy mix of debt and equity to finance operations, balancing risk and return on capital. Seventh, consistency with strategic goals. The financial plan must support the company's vision, mission, and strategic direction as a financial blueprint. Section 10.6 focuses on the goals of profit planning, also known as budgeting. Profit planning involves designing a strategic roadmap that integrates departmental activities. The first goal, identifying cost optimization strategies. Recognizing areas where costs can be reduced without compromising quality or efficiency. Second, forecasting realistic revenue objectives. Setting achievable data-driven revenue targets based on market trends and historical performance. Third, aligning operations with market conditions. Ensuring internal production, procurement, and distribution strategies sync with current market scenarios. Fourth, driving department-wise accountability. Each department should have clear financial targets and KPIs to ensure alignment with the overall profit plan. Fifth, guiding pricing, production, and sales efforts. Budgeting provides a basis for setting prices, determining production volumes, and forecasting sales strategies. Sixth, facilitating short-term gains and long-term sustainability. Balancing immediate financial performance with investments in future growth and innovation. Section 10.7 outlines the essentials of profit planning. These 7 essentials equip managers with tools to achieve organizational profitability strategically. First, accurate sales forecasting. Using historical data, market trends, and advanced forecasting tools like regression models and AI algorithms. Second, understanding cost behavior. Categorizing costs into fixed, variable, and semi-variable to enable break-even analysis and contribution margin planning. Third, production planning and alignment. Ensuring production targets sync with demand forecasts, raw material availability, and delivery timelines. Fourth, effective resource utilization. Optimal use of machinery, labor, inventory, and working capital using ERP systems and productivity tracking. Fifth, continuous monitoring and adjustments. Establishing dashboards and automated reports to enable immediate corrective action and resource reallocation. Sixth, integrated functional planning. All departments must align their efforts through cross-functional meetings and shared KPIs. Seventh, risk anticipation and contingency buffering, including what-if analysis and scenario planning to handle unexpected changes proactively. Before we explore the master budget, let's understand the various types of budgets that organizations use for comprehensive financial planning. Sales budgets forecast expected revenue, production budgets estimate manufacturing requirements, and operating budgets cover materials, labor, and overheads. Capital expenditure budgets project outlays for long-term assets, while cash flow budgets detail expected inflows and outflows of cash. Section 10.9. The master budget serves as the all-encompassing financial plan, consolidating all subsidiary budgets into one coherent, integrated roadmap. The master budget integrates 7 key components: sales budget, production budget, operating budgets, capital expenditure budget, cash flow budget, budgeted income statement, and budgeted balance sheet. Let's examine a real-world example. Lakshmi Engineering Pvt. Limited, a mid-sized Indian manufacturing firm that prepares a comprehensive master budget annually. Based on sales forecasts, they estimate producing 10,000 units per quarter, plan capital expenditure of Rs 35 lakhs for a CNC machine, and project Rs 1.2 crore profit. Section 10.10 examines both advantages and limitations of budgeting. Understanding both sides helps managers implement more effective budgeting systems. Advantages include strengthened financial planning, improved coordination across departments, enhanced accountability, and measurable benchmarks. However, limitations include potential rigidity, time-intensive preparation, risk of becoming outdated in volatile environments, and possible manipulation of targets. Section 10.11 Budgetary control is the systematic process of using budgets to monitor, evaluate, and manage financial performance against predetermined objectives. Key elements include budget preparation, performance monitoring, variance analysis, root cause investigation, and implementation of corrective measures. This enables proactive decision-making, identifies cost leakages, drives transparency and accountability, and encourages fiscal discipline across the organization. Advanced controls like positive pay systems prevent check fraud by verifying issued check details with banks, adding crucial security layers. Let's review the comprehensive managerial checklist for effective budgetary control, covering budget preparation, KPI integration, and performance monitoring. Technology integration includes budgeting software, scenario planning tools, financial dashboards, and forecasting engines for enhanced decision-making. Effective budgetary control empowers teams through clear communication, shared responsibilities, and collaborative goal achievement. As we conclude this comprehensive masterclass, remember that profit planning, budgeting, and budgetary control are not just financial tools. They're strategic enablers. Modern managers must champion simplicity, adapt to change, ensure financial health, and embed profitability into daily decision-making processes. When managers understand and actively shape financial plans using these principles, they transform from operational executors to strategic enablers. A sound financial plan, owned by both finance and functional leaders, becomes a living document that evolves with the business and propels it towards sustainable growth. Thank you for joining this masterclass. And remember, financial excellence is the foundation of managerial success.